Welcome to The Explainer. Today, we're running a really rigorous fundamental teardown of Adtran Holdings. They're right in the thick of the telecom and networking equipment space, and we're going to completely pull apart their latest earnings, dig into the cash flows, and look at some honestly fascinating insider trading signals to figure out what's actually happening under the hood. There's this huge tug-of-war going on with this stock right now between its surface-level performance and its underlying structural health, and we are going to lay the whole thing out for you.
Okay, here's our roadmap for today. We'll start with a quick snapshot of the company, break down those Q1 earnings, check out cash flow and margins, run through the financial ratios, decode those insider signals, and then finally, tally it all up.
All right, Section 1, Adtran at a glance.
$15.18. That's Adtran's stock price as of the market close on June 18, 2026. At this price point, the company is sitting on a market cap of about $1.22 billion. So we're talking about a solidly mid-cap tech hardware company, and one that has absolutely seen its fair share of volatility over the last few years. Keep that $1.22 billion valuation in the back of your mind as we start looking at the actual cash coming in the door.
Moving on to Section 2, Q1 2026 Earnings Breakdown.
Now, what's really wild here is this massive Q1 earnings surprise. Wall Street was expecting an earnings per share, or EPS, of just 9 cents. But Adtran came in at 14 cents. That is blowing right past the consensus with a massive positive surprise of over 55%. Normally, right, a beat of that magnitude sends a stock absolutely soaring because it means the company's operational execution is just crushing market expectations.
And this wasn't just a one-off fluke. They're actually building on a trend from Q4 2025, where they posted an even bigger surprise of over 128%. So they are consistently beating expectations on the bottom line. But here's the crazy paradox. After that Q1 report dropped on May 4th, the stock price actually fell by nearly 14% the very next day. No way, right? Why on earth would the market punish a company that just beat earnings by 55%? Well, to figure that out, we have to look a little closer at the accounting.
Before we dive deeper into the ledger to solve this mystery, it's absolutely crucial to understand that Adtran focuses heavily on non-GAAP earnings to measure their underlying health. Basically, GAAP is the standard accounting rules. But when Adtran reports that 14-cent EPS, they're using non-GAAP. This strips out those heavy non-cash expenses, mainly the amortization of intangible assets from past acquisitions. Management will tell you this gives a much truer picture of day-to-day operations. But as investors, we have to remember that these adjustments can sometimes, mask the real financial burden the company is actually carrying.
Which brings us to Section 3, Cash Flow and Margins. Looking directly at the corporate filings, we see the reconciliation translating those GAAP numbers into non-GAAP. If you look closely, they actually had a standard GAAP net loss of roughly $1 million. But they add back $11.6 million in acquisition-related expenses and amortizations, plus some stock-based compensation to suddenly bridge that gap and report a non-GAAP net income of $10.96 million. Look, it's a perfectly legal, totally common accounting maneuver, but it proves that this huge earnings beat we just talked about, it's heavily reliant on accounting adjustments, not pure operational profit.
And this brilliantly illustrates the friction in their business. Operating activities brought in a solid $12.67 million, but then look at their capital expenditures. Buying property, equipment, developing technology, that cost them almost $16 million. That completely dragged the overall free cash flow down to a negative $3.27 million for the quarter. So despite that massive earnings beat on paper, more actual cash walked out the door than came in. For anyone doing fundamental analysis, negative free cash flow is a massive red flag, and it's probably exactly why the stock dropped 14% after earnings.
Let's zoom out a bit for Section 4, Analyzing Financial Ratios.
These numbers paint a pretty constrained picture. A forward PE of 26.25 means the market is definitely still pricing in some growth expectations, but an EV to EBITDA ratio over 15 is getting a little rich for a hardware company bleeding cash. But the metric that literally jumps off the screen is the debt-to-equity ratio of 1.77. That shows some serious leverage on the balance sheet. They have nearly twice as much debt as equity, which significantly turns up the risk dial, especially in a high-interest rate environment where debt just gets more and more expensive to service.
And then there's the return on equity, sitting at a deeply concerning negative 18.61%. Pair that with a negative return on invested capital of 0.40%, and what does it mean? It means that right now management is not generating a positive return on the capital they're deploying into the business.
The engine is running, the revenues are coming in, but the actual returns for shareholders are currently completely underwater.
Let's pivot for Section 5, Insider Trading Signals.
Now, in stark contrast to that negative cash flow and high debt we just looked at, the top executive stepped up massively late last year. The CEO, Thomas Stanton, bought over $300,000 of stock straight out of his own pocket. A director bought over $100,000, and the CFO threw in almost $50,000. Now, executives might sell stock for a million different reasons, buying a house, paying taxes, whatever. But they generally only buy for one reason. They firmly believe the stock is going up.
This unanimous buying consensus over the last 12 months is a huge psychological indicator. We've got 3 insiders buying, literally 0 insiders selling, for nearly $450,000 in total buying volume. Total insider ownership is now sitting at 2.16%. This strongly signals that management thinks the stock is incredibly undervalued, despite all that operational friction we just uncovered. They're looking at their Q1 revenue of over $286 million and clearly betting that they can turn the ship around towards sustained profitability.
Which brings us to Section 6, the final tally.
So as an objective observer, you've got to weigh these two completely opposing realities. On the bullish side, Adtran is pulling off massive back-to-back earnings beats on a non-GAAP basis. They're operating at huge scale with $286 million in Q1 revenue, and key insiders are putting their own personal wealth on the line. But then on the bearish side, you've got those structural issues, negative free cash flow because of heavy capital expenditures, a high debt-to-equity ratio of 1.77, and a deeply negative return on equity. So I'll leave you with this final thought to apply to your own investing strategy. Which metric do you think ultimately dictates the future reality of this company? Do the insiders know a turnaround is imminent, justifying all those accounting adjustments? Or is the negative cash flow the undeniable gravity that'll eventually pull the stock down? It's a classic battle between insider confidence and fundamental friction. Thanks so much for joining me on this explainer, and definitely keep these critical frameworks in mind next time you're tearing down a stock.